Hello, fellow entrepreneurs. So happy that you are here today, and I'm excited to see you and share with you today the top 3 mistakes that entrepreneurs make when they are starting their business, or even when they have their existing business, some steps that they might have skipped. So the first step that we have is number one is a lot of entrepreneurs, side hustle businesses, they use spreadsheets versus using a software program. And to me, this is like one of the big mistakes because spreadsheets are very difficult to use for some people. Some people love spreadsheets, and so there's no issue with that whatsoever. But your numbers aren't confirmed in spreadsheets. There's a lot of mistakes that you can make on spreadsheets and calculations in uploading the numbers into the spreadsheet. So I want to avoid that discomfort for you with spreadsheets where we use a software, an accounting software, to keep track of all of our numbers for us. And it will save us, first one, money. It will save us the time it takes doing all this, because nobody wants to, on their weekend, sit down and have to do bookkeeping, or after you've had a long day, have to sit down to the test and say, oh my goodness, I've got to get this bookkeeping done. I've got all of these things that I need to do. And then I've got this going on the next day. So I want to help you through that process so that you're not just like, that you're screaming about everything. And so, but anyway, like with QuickBooks Online, it's very inexpensive to get started on there. They even give you a 30-day, free trial. You get 50% off for the first 3 months, or you can get 30% off for 6 months. So I believe it's very affordable, and we really have to take, advantage of the technology that we have today and use that technology. And then the next thing that entrepreneurs make, a big mistake they make, is actually not having their chart of accounts set up correctly, because everything flows from the chart of accounts into your transactions, into your accounts payable, your accounts receivable, and all of that ends up on your financial statement. And so your financial statement, it tells the story of your business, the trend of your business, what is selling, what is not selling, whether that is a product or that is a service. And then you can look, say, at the end of the quarter and see how much money that you have earned, and what percentage of that you need to pay some taxes on, or you want to transfer to a savings account for a new project that you have. So all of those things help us in our business of just knowing where we're currently at in the business. And with the cheat sheet that I did give you to help you record all of your transactions and how we number these accounts, so you can easily find these accounts and in the future correct any errors of a transaction that you do put in, because sometimes occasionally we're going through the bank feed, we meant to click on office supplies and we clicked on automobile insurance. So those little things can happen because we're human. But we do discover those things as we're reconciling our bank accounts, and so we can correct that. So most mistakes, are just little things and you can correct very easily. So, but we will continue in that today and go over that cheat sheet that it is in the description. It's free for you. And what I want you to do is just save that on your computer, print one out, and have it beside your desk here when you sit down to do your accounting. And then that will make it really easy, because we're going to use all the account numbers that I have on that cheat sheet, because they're really simple. And then you can add more accounts as you're building your business and as you're offering different services, different products, different vendors that you're buying things from, different expenses and things like that. So we're going to add to that continuously every week. So that's amazing. And then the next thing that a lot of entrepreneurs, they skip as I'm working with different clients and working with different businesses is they don't connect their bank feeds. And your bank feeds are in QuickBooks will connect your business bank account, your business credit card to QuickBooks. So when you click the update button every day or once a week, whenever you're going to do your books, then you'll see every transaction that's went through that account, whether it's a credit card or a bank account. It could be PayPal. And so PayPal syncs with QuickBooks as well. So this is a way that your software actually pays for itself because it's, taking up the time that it would take you to do that on yourself, on your own, not on yourself, but on your own of taking the time, going into the bank website, going down all your expenses and everything where you can just log into QuickBooks anywhere that you are on your phone, on your tablet, on your desktop, and see all those transactions coming in. And if someone charged something to your account that you didn't approve, then you know to call that vendor or you call the bank and just dispute that charge. So that's always good. And one little hack I can tell you, like when you're buying things from vendors, if you do put it on your credit card, it's easier for you to dispute if a vendor charges something to your account that you didn't approve, opposed to your bank account. So that's just a little hack sometimes I use, especially if it's a large expense. Say, like I'm getting a website design, and this just recently happened, to me. They charged my credit card, which was fine, but then I wasn't happy with their service. So I had to go in and end up, disputing that. And so that really helped me out a lot because sometimes it's hard to get refunds from vendors. But those situations can happen. Or if you're on a subscription basis, say, with any company, then you canceled it and they charged your account anyway, then you can go in and dispute that transaction. Okay. So connecting your bank feeds, we will actually be going over that next week, but that will be the next topic. So be sure and listen in on my videos to see how we connect that together. It's very painless and very easy. And I do put out my videos every Wednesday. So you can start working on it during the week and then on the weekend as well if you're going to work on your accounting on the weekend. So, okay. I just brought up the cheat sheet that I have for you, the top bookkeeping basics for beginners. And so this is your startup business accounting cheat sheet. Our assets, which are like our bank account, invoices, or accounts receivable, and inventory, those are the products that we're purchasing to resale. So you have a purse business, as a friend of mine has, and she has beautiful purses that she will buy purses, and all of those will go into the inventory. And as she sells those, it will reduce how many she has in inventory. So say when she gets down to 20, that she can reorder her product. And so all of these assets start with the 1,000 account. So like the bank account could be 1,002, 1,006. Accounts receivable, that account will always be 1,200. And then your inventory, it can be like 1,210, something like that is a good number for that. I kind of do even numbers. I'll go 1,002, 1,004. So if I need to add any extra counts in there in the future, that I have a little space the way that I want them to look in my chart of accounts. So that's a little tip there. Then the next thing is the liabilities, and these are bills to be paid, things that people we owe money to, vendors we owe money to, loans we owe money, and that is a 2,000 account. So you'll have your accounts payable, and say we get a bill in from Verizon, So we could enter that bill into the accounts payable, and we know that we have to pay that on the 23rd. So we mark for that to be paid on the 23rd. So we can pull up a report of all of our accounts payables, and it'll show us all the bills that we owe for the month there, or the 6 months period, however you're putting in your bills whenever it's due. And then we'll have our loans in there. If you loan $10,000 to your business, then we'll have that loan where if you want to pay yourself back after you receive some money, like $1,000, $500, then that would go back against that loan that you loaned to the business, just like you were the bank. And then we have our payroll. If you do run payroll, your payroll liability accounts. This is money that we withheld from employees' paychecks, and then money that we owe the IRS, where we had to match the federal, and not the federal, but the FICA and Social Security tax. And then the unemployment tax that we have to pay the state and the federal government, that is not taken out of a payroll check. And then we have the credit cards that we're using in our business, and QuickBooks has a unique way of handling credit cards. So that will be in the next video when we connect our credit cards to the business. Okay. But these go under 2000. So accounts payable always just uses the 2000 account. Loans, you could do like 2004. Payroll liabilities, you could do, say, 2005. Credit cards, I put it really usually right under accounts payable. So maybe we'll do 2002. So those are some suggestions. Of course, you can make up whatever 2000 number that you would like. And then our owner's equity, and this is the activity of ourselves in our business where we contribute money that we're not going to take back out as a loan. It's where we have partners in our business. They may contribute, different funds to our business, and they're going to get paid back depending on the profits in our company. But that's another video. I won't go into that today. And then when we withdraw money out, say that even in your business, say that you went to Kohl's, and you charged something there that was, $100, then that would go against your draws for the business, because that is not something that is tax deductible. And that does happen occasionally where we use the wrong, credit card or the wrong debit card for that. So, or if you just need to draw out $500 out of your business, then that would be under your draws. But all of these accounts go by a 3000 number. And the owner's equity account, it will always be a zero balance. So anytime you look at your chart of accounts and you see that there's a balance in there, then you know that it's something you need to correct. Sometimes QuickBooks, like if you buy a computer and you automatically put it into QuickBooks and not designate the accounts that you want that going to, then it will put it into owner's equity. So you've got to get in there and switch it out to computer expenses. But all of these accounts, like I say, will be under the 3000. So owner's equity is a 3000 contribution. For instance, you could put 3002, owner's draws 3004, and then your retain earnings, and this is the profits or the losses that occur from year to year accumulatively. Then you could put that, maybe I put that a different number like 3400 or 3600 just for that to stand out for me. And then we have our income account, and this is an account we use with 4000, and it's a credit account, and we're not going to get into a whole lot of that right now. But say, for instance, you received $800 for a sale on your products or your service, then we would be debiting our bank account $800, increasing our balance in our bank account, and crediting the sales account. And so that would show your income. So that's the credit side of that. So in natural, Your bank accounts would be a debit. Your sales accounts are going to be a credit. And we're always balancing those two. And then your income accounts, this is for your products that you sell. This is for the services that you offer. Or it could be, say, you get residual income from something, that would also be in there. And so we'll put, like, say, our products as a service, like account 4002, or services 4004, or interest income that the bank would give us, maybe 4010, 4010, and then other business income, maybe 4012. And with the products and services, I like to break that out. Say, for instance, going back to my friend that has a purse business, that her products, would be, say, purses. That's the type of product she's selling. And then if she offered a service, then it would be, something like coaching services or anything like that. That's not a very good example of that, but let me try and think of a better example. Okay, I have a client. He actually puts in the restaurants, the control panels, like where you order your food and you pay for your food right there at the table. So like for his products, he would be selling computer systems to the restaurant. He would be selling different phone products and equipment. So that would be his products. His service then would be phone support for those equipments. So then that gets divided up between the two. And so I hope that didn't, confuse you a little bit there. But anyway, if you name your products and services, then that helps you a lot to see what products and services that you are doing best in, that you are selling the most of, that your customers like, that there's a need out there for, or, because this is going to generate your most income. Okay, then we're going to switch down to our cost of goods. And our cost of goods is directly related to a job or a product that we are producing. So this will be a debit account. All of our expenses are debit accounts. And that would be $5,000. For instance, when you pay, say you purchase some supplies, it will be debited to your expenses. And then that money comes out of your bank account or goes to your credit card. And so that would be credited to your bank account or credited to your credit card. So, but the major ones that we work with are supplies and material, labors paid to employees or contractors. And you would want two separate accounts for those. One, labor paid to employees, labor paid to contractors, to divide that up. Because with contractors at the end of the year, if you paid them over $600, you will need to issue them a 1099, which we do quickly and easily through QuickBooks Online. So it's real simple doing that. And then freight and postage and shipping could be a cost of good for that product when you have to ship it out to someone. And then the other costs that you might incur on the job, it could be if you are actually making something in a factory or home office and you're putting together things and 3 or 4 people come over and you're packing envelopes, stuffing envelopes, then you could order lunch, and then that would be other costs, contained in that job. So it can be simple things like that. But you can name those 5,000. I usually do a title of cost of goods, and then for supplies and material, I would do 5,002, labor 5,004, 5,006, freight 5,008, maybe 5,010 for the cost on the job. So that's how that works. And then the next one, the final one, is going to be our expenses. And this is all our overhead costs, which means whether you had a customer or not, that you would still have to pay these expenses. And those things are like our auto expense, which the auto expense can be variable and it can be fixed. You would have your gas, your oil change, your car wash. If you're doing mileage, you would just, at the end of the year, when you file your taxes or your CPA files your taxes, they would put in the mileage for you. But during the year, we still keep track of what the actual costs were. And right now with IRS, you get paid 65 cents per mile. So that can really benefit you in your business and give you a very nice write-off. Excuse me. But then for, auto expense, also, you could have your auto insurance, and that would be a fixed expense every month or every 6 months, however you pay your premium. So that isn't a variable in your insurance. Then you have bank charges, and your bank charges could be monthly fees that your bank charges you. They can charge you a fee for a return check, for a copy of a check, any special service that they provide, that will be your bank charges. And then interest on any loans or credit cards, that would be another expense for your business that is tax deductible. Everything here is totally tax deductible for your business. And then your computer or equipment you buy, anything up to $10,000 in 1 year, you can write that off. If you do want to write that off over a 3-year period or a 5-year period, you can also do that. Your office supplies, anything you buy for the office, then you could take that deduction as well. And even if you have an office, say in 1 bedroom in your home, you can take off for office in your home deduction. And then when you're meeting clients or you're meeting vendors or anything really connected with business, you can write off your meals and your food, and you actually get a 50% write-off for that. Say the meal was $50, you put in $50, but on your tax return, when your CPA does that, he cuts that in half, so it's only 50% off. Now, when you go to a conference, all of that is 100% write-off there for that conference. Any conference, any training programs that you buy, any coaching, say that me and you did some coaching together, then that is totally deductible on your taxes as well. It lowers your profits, so it lowers the amount of money you have to pay on your income. And then, of course, we spoke about, contractors, but then you can have office contractors. Say that you're remodeling your office or you hired a plumber because you had a leak, then that would go towards your office contractors and not your cost of goods, because it's not related to a project that you are doing. And so then we have also our rent for our office. If we do rent an office, if we go out of town and we rent like a 1-day office, we can write that off. If we have storage that is for our business, we can write that off as well. So those are some great deductions. And of course, we get to write off our payroll. If we don't have any W-2 employees, then we won't have any employer taxes, except for at the end of the year, an unemployment tax we have to pay for being self-employed. We do have to pay that, and that is fully tax deductible. And then we have our dues and subscriptions. And this is the one that I urge you guys to watch the most, because we do everything so much in the cloud now that those expenses can add up. And we just want to make sure whatever subscriptions we do have, that we're actually using those subscriptions. And then, we have processor payment fees where we're offering to our customers, they can pay us by credit card. And of course, the credit card company charges us for that transaction. So that's an expense we have to incur. Sometimes different clients, they will charge that back to the customer. And then in certain situations that you're just taking on that charge. If it's anything, I always say like over, $500, I typically want to charge that back to the customer, but if it's under 500, then I'll just offset that myself. I'll take care of that myself. And then we have our utility, and that's our electrical, our water, our internet, our phone bill. It could be your telephone bill that you use to run your business. So like when you're doing your home office deduction, you can take a percentage of your electric, your water, and your internet and your phone bill to write off as a business expense. So that's very helpful in your business. But those are some of the categories there that we go through when we do our chart of accounts. Those are examples of our chart of accounts. Next week, we are going to do a deep dive into the chart of accounts, including adding and editing accounts to customize your chart of accounts for your amazing business. Take care and have a good week. Talk to you soon. Bye-bye.